Most retirees are hemorrhaging thousands of dollars in unnecessary taxes every single year. And the brutal irony, the IRS literally built a 0% capital gains bracket right into the tax code, and almost nobody is using it. That's not a typo. 0%. While your neighbors are blindly handing over chunks of their hard-earned retirement savings to Uncle Sam, savvy retirees who know this strategy are legally keeping every dollar of those gains for themselves. We're talking about a legitimate, IRS-approved tax bracket that could save you tens of thousands, potentially six figures, over the course of a 30-year retirement. The difference between those who retire wealthy and those who slowly bleed their portfolio dry often comes down to one thing: knowing exactly which accounts to pull from, when to pull from them, and how to surgically position yourself inside this 0% sweet spot. Ignore this, and you're essentially writing the government a voluntary check. Master it, and you keep your money where it belongs, in your pocket. Buckle up, because what we're about to walk you through isn't financial fluff. It's a battle-tested, step-by-step withdrawal blueprint that could fundamentally rewrite your retirement financial future. Here's the brutal truth nobody in your financial advisor's office wants to say out loud. Most retirees are getting absolutely destroyed by taxes they never had to pay. Not because the tax code is unfair, not because the system is rigged, but because they walked into retirement with zero withdrawal strategy and handed the IRS a blank check. If you've spent 30 or 40 years grinding to build a nest egg, and you're just pulling money out of whatever account feels convenient, you are leaving tens of thousands of dollars on the table, guaranteed. This blueprint exists for one reason: to make sure you are not that person. What you're about to learn isn't theory. It's a battle-tested, sequence-driven withdrawal framework, engineered specifically to legally minimize what you owe, maximize what you keep, and make your money work with ruthless efficiency for every single year of your retirement. The clock is already running. Every withdrawal you make without a strategy is a withdrawal that's costing you more than it should. So pay attention, because what comes next could be the most financially important thing you ever read. Let's cut straight to it. The 0% capital gains bracket isn't a loophole, a grey area, or some shady strategy cooked up by a tax attorney in a back office. It is sitting right there in black and white on the IRS website, completely legal, completely legitimate, and completely ignored by the majority of retirees who keep blindly handing Washington a check they never had to write. Single filer, under $47,025 in taxable income, zero federal tax on your long-term gains. Married couple under $94,050, same deal, absolute zero. We're talking about potentially thousands, even tens of thousands of dollars per year that you get to keep simply because you understood the rules of the game. This isn't about being clever. It's about being informed. The wealthy have known this forever. Now you do too. The only question left is whether you're going to act on it or keep overpaying out of habit. Here is where most retirees quietly lose thousands of dollars without ever seeing it happen. They retire, start pulling from their traditional IRA first because it feels like the obvious move, and suddenly their taxable income jumps. Social Security becomes partially taxable, required minimum distributions layer on top. Before they know it, their income has crossed the threshold, and every dollar of capital gains is now taxed at 15% instead of 0. They did not make a reckless decision. They simply pulled from the wrong account, in the wrong order, at the wrong time. That one sequencing mistake compounds across decades. This is exactly the problem the Project 120 blueprint is designed to prevent. The solution is not earning less. It is engineering your income so the right dollars show up at the right time. Let's cut straight to it. If you're not aggressively coordinating your Social Security timing, Roth distributions, and capital gains harvesting as one unified tax machine, you're hemorrhaging thousands of dollars every single year to the IRS, completely unnecessarily. Most retirees stumble into retirement with 3 powerful tax-free income tools sitting right in front of them and somehow manage to use all 3 wrong. Claim Social Security at the wrong moment, you've just torched your 0% bracket. Pull from your traditional IRA without a plan. Watch your capital gains rate jump to 15% overnight. Project 120 exists precisely because this coordination gap is costing everyday retirees real, recoverable money, and the strategies to fix it aren't complicated, they're just criminally underused. Now let's get into the first pillar of the Project 120 blueprint, strategic account sequencing. This is simply about which account you pull from first, second, and third. In early retirement, before Social Security begins, and before required minimum distributions kick in, you have a rare window of control over your taxable income. The general sequence goes like this. Start with your taxable brokerage accounts, specifically selling positions with long-term gains that fall inside the 0% bracket. Next, supplement with Roth distributions if needed, since those carry 0 taxable income. Pull from your traditional IRA last, because every dollar withdrawn there counts as ordinary income and eats directly into your bracket room. Most retirees do this completely backwards, draining Roth accounts early and leaving taxable accounts untouched. That single mistake costs thousands annually. Now here is where the blueprint gets genuinely powerful. The window between age 65 and age 73, before required minimum distributions kick in, is the single greatest Roth conversion opportunity most retirees will ever have. During these 8 years, your taxable income is often at its lowest point in decades. You are likely not yet drawing Social Security at full benefit, and your traditional IRA is sitting untouched, growing and waiting to become a future tax problem. This is your window to act. By converting portions of your traditional IRA into a Roth each year, you are deliberately filling the lower tax brackets, the 10% and 12% zones, without pushing your income high enough to trigger the 15% capital gains rate. You are essentially paying a small tax now to eliminate a much larger tax burden later. Let's make this real with actual numbers. Meet David and Susan, both age 65, married filing jointly. They have $1,200,000 sitting in a traditional IRA and no Roth savings yet. Their only income is $40,000 from a part-time consulting arrangement. The 2024 standard deduction for married couples is $29,200, leaving roughly $10,800 in taxable income. That means they have nearly $83,000 of remaining space before hitting the $94,050 threshold for the 0% capital gains bracket. So they convert $80,000 from their traditional IRA to a Roth each year. Over 8 years, that's $640,000 converted, dramatically shrinking future required minimum distributions while locking in tax-free growth for decades ahead. Here is why this matters so deeply inside the Project 120 blueprint. Every single dollar you convert at 65 is a dollar that will never appear as a forced, taxable required minimum distribution at 73, 80, or even 90 years old. Think about what that means across a 30-year retirement. You are not just avoiding one tax bill, You are eliminating decades of mandatory withdrawals that could push you out of the 0% capital gains bracket year after year. Each converted dollar gets to compound inside your Roth account, completely tax-free, and when you eventually pull it out, the government gets nothing. That is the real power here. You are essentially buying decades of flexibility and tax-free growth with one intentional decision made during your early retirement window. This is not tax avoidance. This is the blueprint working exactly as designed. Now here is where many retirees unknowingly sabotage their own strategy. It is called the IRMA trap, which stands for Income-Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain thresholds, Medicare automatically charges you higher Part B and Part D premiums the following year. For 2024, a single filer crossing $85,000 or a married couple crossing $170,000 triggers the first surcharge. That can cost you thousands of extra dollars annually. Here is the dangerous part. A Roth conversion that pushes you just $1 over the threshold activates the entire surcharge. So your tax savings from staying in the 0% capital gains bracket can be completely wiped out by surprise Medicare costs. This is exactly why your conversions and harvesting must be coordinated together, not planned separately. Now, here is where the Project 120 blueprint gets genuinely powerful. Inside the 0% capital gains bracket, retirees can do something called tax gain harvesting. This is the intentional opposite of tax loss harvesting, and most people have never heard of it. Here is how it works. If you hold appreciated investments in a taxable brokerage account and your income qualifies you for the 0% bracket, you can sell those positions, realize the gains completely tax-free, and immediately repurchase the exact same investments. What you have just done is reset your cost basis to a higher number. Future gains will now be calculated from that new, higher starting point. No wash sale rule applies here because you are harvesting gains, not losses. Done annually as part of your blueprint execution, this quietly eliminates embedded taxable gains before they ever become a problem. Now let's talk about Social Security, because this is where many retirees unknowingly shrink their tax-free space. The IRS uses something called provisional income to determine how much of your Social Security benefit gets taxed. The formula adds your adjusted gross income, any tax-exempt interest, plus 50% of your annual Social Security benefit. If that total exceeds $25,000 for single filers or $32,000 for married couples, up to 85% of your benefit becomes taxable income. Here's why timing matters inside Project 120. If you claim Social Security early, that benefit immediately enters your provisional income calculation every single year, compressing the room you have available inside the 0% capital gains bracket. Delaying your claim, even by 2 or 3 years, can preserve thousands in annual conversion and harvesting capacity, giving your blueprint significantly more flexibility throughout retirement. Everything we have covered comes down to one repeatable ritual you run every single year. Start each January by estimating your total taxable income for the year ahead. That single number drives every decision that follows. Once you know your baseline, identify how much conversion room remains inside the 12% bracket before you cross into the 22% zone. Next, determine whether tax gain harvesting makes sense given your current unrealized gains and your position inside the 0% capital gains threshold. Then review your Social Security provisional income calculation to confirm you are not accidentally pushing more benefits into taxable territory. Finally, Verify your modified adjusted gross income stays below the Medicare ERMA thresholds. This is not something you do once at retirement and forget. This is an annual optimization ritual that compounds in value every single year you execute it correctly. Now here's the objection I hear constantly. This sounds great, but I need a professional to figure this out. And while working with a qualified advisor or CPA absolutely adds value, it is not a requirement to get started. A retiree with basic spreadsheet skills can model this entire strategy independently. The IRS publishes current bracket tables directly on irs.gov at zero cost. You simply need 3 numbers: your estimated ordinary income, your projected capital gains, and your account balances across taxable, traditional, and Roth accounts. Build a simple spreadsheet with those inputs, reference the published thresholds, and you can see exactly where you land. Free tools like the IRS Withholding Estimator also help you stress test different scenarios before making any moves. Knowledge is the real barrier here, not complexity. Here is the truth. Most financial media ignores. The 0% capital gains bracket was not designed for billionaires hiding money offshore. It was built specifically for retirees living on moderate income. Congress literally wrote this bracket for people in your situation. That changes everything about how you should approach withdrawal planning. Every year you spend inside this bracket instead of above it could mean tens of thousands of dollars staying in your pocket across a 30-plus year retirement. That is a return no stock can guarantee. So this week, open a spreadsheet, pull your account balances, and map your withdrawal sequence against the thresholds we covered today. Revisit your Social Security timing. Check your conversion room. Run your actual numbers. Tax planning is not paperwork. It is the single highest return investment available to you in retirement. Project 120 starts now.